Welcome back to Switzer. With the Australian dollar falling, and in the case of Steve Keener's worried, in case he has worried too much, it's time we got a dose of Clifford Bennett's irrepressible positivity. Welcome, Clifford.
Thank you, Peter.
Now, I did joke in my introduction that, you know, you'll never see Clifford Bennett negative in your lifetime, but of course you will one day become negative, but well, it's a long way off, isn't it?
There was that negative period, 2007 to 2009. I mean, I was an aggressive bear all through that.
Yeah.
So I think I've sort of got that out of my system. Now,
Yeah.
you know, the markets and the world economy, the US economy, everything's pretty much panning out exactly as we've said with the White Crane report all through the years.
Yeah.
Recently, the Australian dollar's a lot lower than I thought, and gold's had a bit of a pullback. But you couldn't sort of really describe a more fundamentally sound and robust global economy.
Okay, a lot of people will be wondering, is this going to last? Because, you know, if Ben Bernanke says...
Well, it's just starting.
Yeah, okay, well, you're saying it's just starting, but a lot the current thinking. So I want you to look at the current thinking that my viewers be worried about. Right. If he starts pulling back on QE, tapering the word as they're using, you know, will the market fall off? I said maybe temporarily, but it wouldn't be deep and very long. But when the full QE goes, would the market be spooked? Take it away, Clifford.
Well, on your last show last year, Peter, I said for this year, minimum target 5,200.
Yep.
With the potential to go to 5,700. And I think we'll see that. And I think we'll see the Dow Jones a lot higher. You know, my 1 to 2 year target for the Dow Jones that I've had for a few years, 20,000.
Massive, yeah, 20,000.
20,000, I set that when we were way down.
I think there were guys out there with white coats after you said that.
Yeah, I got chased down the street, in fact, but I managed to get away. Yeah. But the reason I'm still so bullish is because people have to understand that this whole quantitative easing, particularly QE3, is a complete furphy. It wasn't necessary in the first place, and when it's removed, the US economy will continue. Why was it necessary? It was never necessary, because what was happening in the US was that the consumer was coming back on strong anyway. We had strong bank
interest rates to get to really low levels?
But they were already at really low levels. Because what QE3 does is buy mortgage bonds, which means it keeps mortgage rates low, which is why you have a very buoyant market in the existing home market. Real estate
isn't that a good thing to underpin a recovery?
QE3 makes real estate agents rich. It doesn't really affect the real economy that much.
But people feel better. Like when I'm seeing a house that I thought was worth 300 is now worth 100.
Yeah, no, that's good. But you know what it is? It's people thinking that Uncle Sam had to save the day when Americans needed, as previously the most entrepreneurial country on earth, to get off their backsides and make it happen for themselves again. That's what they're now doing. So there's less of a need for government stimulus.
Okay, so
the economy will stay strong, the markets will go up, even with removal of QE3.
Okay, so you're not worried about USA. I know you haven't been a great fan of USA, but you're not worried about it.
No, it's the old first world.
But you're not worried about it. Okay. Let's go to China, because we're going to get PMI figures this week, and it was the last flash PMI that spooked everybody and took commodity prices down.
No, it's a terrible PMI, wasn't it? Manufacturing's still expanding after expanding for 15 years.
It missed by 0.3% of an economist forecast.
I've always said that, look, the Chinese are purposely redirecting their economy towards the service sector and a consumer society. Right. And they're great terms that everyone uses. But when you get on the ground in Beijing and you find out what that actually means, the empowering of farmers in rural China, the urbanization of middle China now after the eastern seaboard's been urbanized, we're only halfway through the urbanization process. China's now shifting that emphasis to the middle kingdom, if you like. And so the demand for our resources is going to go through the roof.
So you don't believe that the fall in commodity prices, it went down, they came back.
The fall in commodity prices means that the oversupply that everyone feared won't happen. Because mining companies have gone, this is just too hard, this is just too volatile, we're not going to build these expensive plants or have expensive production when we're not sure what the price is going to do. So a whole lot of that future supply that was there going to occur has now been eliminated, and more of it will be eliminated. But demand will continue to increase. All through these price shifts of commodities, the demand for commodities out of China and all of Asia has not gone down. It's only ever gone up every month, month after month.
Yeah, I never talked to you about stocks per se, but therefore my analysis that BHP is actually a buy at these levels.
Absolutely.
You support it?
Oh, sure.
Okay, right.
We're only just starting to accelerate in equity markets. The stock market, the risk in the stock market is upward price acceleration, not correction.
Japan, Abenomics, if that's what Is that going to be good for Japan and therefore good for us?
It's mildly good for Japan, but I always describe Japan as we'll have a sell-off in the yen, and then they'll switch their nuclear reactors back on, and then we'll have a huge rally in the yen. We may have seen the top in dollar yen in the last couple of days. I'm a buyer of yen because there's already now starting to be that talk that I always said there would be about turning the nuclear reactors back on. The problem with Japan has been a power shortage. They've had power rationing, they've had enforced leave periods in factories, reduced shifts to try and manage the power shortages. As they turn the nuclear reactors back on, the economic data will continue to spike higher.
Okay, let's go to Europe.
Europe?
Yeah.
I've been wrong on Europe. I expected positive growth by now.
And why were you wrong? You're a person who ponders your mistakes as well as your successes.
You know, I think there has been a lack of consumer confidence. You know, it's interesting. The United States
underestimated the impact of austerity on
a little
European
bit.
cycle?
Yes, I know what got me was that voters voted for austerity, but now they've reacted against it still in terms of retail sales and spending and that sort of thing. But one of the main problems with Europe at the moment is how much the banks aren't lending. Remember coming out of the GFC here, how banks wouldn't lend to our property developers, right? The Americans were the same. That's what we're seeing in Europe now. Once the CEOs of the major banks of Europe start to say, let's start lending again, because this could be the bottom.
Well, Draghi's going to try and make him, isn't it?
And I think it's going to work. So I expect positive GDP this quarter for Europe.
So when I say I was expecting green shoots by the end of the year, that's not too way out?
No, I think it's conservative. I think we're going to have positive growth for the year, and it's going to start this quarter. It was only a 0.2% contraction.
Come back home now. What's Aussie dollar first, because that's home. What's going to happen? How low will it go?
I didn't expect the Australian dollar to get under 101, 102. So I've got this medium-term move very wrong, okay? But I did get the move. I thought we'd have weakness through the budget and into Wednesday, and then Thursday we'd get a bounce. We got that, but I didn't expect the fall again on Friday. I thought we were going to bottom above 98 cents. I think we're going to bottom now. I think we probably have bottomed in the last day or two.
You're expecting to see 96?
No, I'm expecting to see 103.
But if China's PMI number happens, they'll sell the Aussie dollar, won't they? That's going to be an important number this week.
The thing is that, have you noticed in the price action, gold and the Australian dollar, 10 trading days, very similar. Our currency has basically just experienced a hedge fund speculative attack. An attack by hedge funds.
So the name Soros was mentioned.
And no one minds because the currency's lower. I mean, we should have higher principles than that. But the point is that the hedge fund shorts need to be bought back. So almost all of the selling we've seen in the last 10 days needs to be unwound and bought back for profits to be taken. Plus, the China story is still extremely robust, as I kind of just outlined now. And so I think the resources boom is ongoing. Markets have priced in an end of resources boom. In the same way as they priced in a depression in 2009 that was never going to happen, they've now priced in a end of resources boom that isn't happening.
I took a punt on one of my blogs to say, buy in May and stay. Was it too risky?
Peter, I can't believe you did that. It's almost like you've converted.
I know.
I think that this time it's a complete inverse situation, and so that's why I'm saying upward price acceleration. So I think it's a nice corner.
Okay, what can go wrong? It's all very well to have everything, but you must also say what can bring all this undone.
What could bring it undone is that Europe backs away from austerity too much, and it starts to unravel a lot of the bond relationships there, and people try to attack the sovereign debt issue again. So I think Europe will hold the line reasonably well. We're certainly not going to see more austerity, but it's important they don't back off too much. And I think Europe is starting to see rays of sunshine. Germany's certainly strengthening again. I think we just saw our worst data there. But Europe's still the risk, but I don't think it will unfold.
Okay, finally, the Aussie market hasn't performed as well as the US stock market. After the election, do you think there'll be like a business confidence bounce and a stock market bounce and a consumer bounce?
Well, to give you an idea how strongly I feel that, Peter, I forecast this year for GDP for Australia to be just 0.8%, as everyone pulls back.
For the financial year or the calendar year?
Okay. As everyone pulls back from investing, as bad policy and policy redundancy, if you like, grips the nation. But next year I'm forecasting GDP to be 4.5%. It's going to be a bursting of a dam of potential investment that's been held back. And once that dam is burst, it's going to be quite impressive. And no one wants to preempt this election. So there isn't going to be people investing beforehand on the basis of the polls. People are sceptical of polls these days. They know how close the last election was. People are actually going to wait till the election is out of the way and then aggressively invest, I believe.
Well, I certainly argue there'd be two halves. The first half of the financial year will be slow, the second half will be fast. But 0.8, that's a pretty low number.
I think I'm pretty wrong on that. I'm pretty wrong on that.
Oh,
I think it highlights the risk to the economy. The risk to the economy
I was
is very
thinking
much
more
the
like a
downside.
2-ish kind of number,
I mean,
going up to a high threes maybe.
It's certainly about 0.8% for our domestic economy, which 95% of Australians experience. Yeah? So that's the number that matters. That's what it is for them.
Okay.
And 16% for the resources.
Now, we're out of time, but is a White Crane event you want to quickly tell?
No, the White Crane Group, new website, .com.au.
Okay. Have a look at that.
Have a look at that.
All right, mate. And before we go, I'm speaking at a Parkinson's corporate lunch to help the sufferers of Parkinson's disease. It's in Adelaide this Friday at the Sanctuary Restaurant in Adelaide Zoo from 12 to 3 p.m. For more details, go to the sanctuaryadelaidzoo.com.au. Hope you can make it. And if you want to read my thoughts each morning at the close of Wall Street, check out my website, switzer.com.au. And if you've got a self-managed super fund, have a look at the switzersuperreport.com.au website. I'm Peter Switzer. Thanks for watching. I'll see you tomorrow night.